Valens Research, Uniform Financial Analytics.
Perficient. And so for Perficient, for those of you who don't know, is a specifically focused on, it's a consulting firm, but they're really what's called a digital agency consulting firm. So they're consulting, but consulting with, almost on the cusp between consulting and advertising and marketing, if you will. So when we come here to look at Perficient, just like we look when we see any company for the first time on the Valens Research app, we come to what we call the PVP chart, or the Performance and Valuation Prime Chart. You'll understand why we call it that in a moment, because we're very literal people here at Valens. It's because of the fact that we're focusing on the performance of the company in terms of our uniform accounting return on assets and asset growth, right? How the company is profitability-wise and how it's reinvesting, and valuation, right? In terms of our valuations relative to assets and relative to earnings. When you look at these charts, you'll notice there's a blue and an orange bar. The blue bar are the uniform accounting true blue real corporate profitability for these businesses. Well, the orange bars are the distorted as reported ROA of this business when we look at the GAAP as reported ROA that is incomplete in terms of the real understanding it gives you on corporate profitability. And for Perficient, we can already see the issues. Look at this. If you look at this on an as reported basis, you would think this is a consulting business that's only earning a 5% return on assets. A consulting business that has returns that low, that's unheard of, right? As a consulting business, you should be an asset-light business, high margin, high profitability business, and this company is doing anything but that until you look at reality. And then when you look at reality, you can see that the real returns of this business are over 40%. Those are incredibly high returns. The average corporate in the US right now is earning around a 10% return. So we're talking about 4x corporate average profitability here. But if you looked at the as reported metrics, you totally wouldn't even realize that. You'd think that this was a 5% return business. You'd think it was a bad business. And that's the first thing that we're highlighting here when we look at the Performance and Valuation Prime, just how wrong as reported metrics are and how those distort how you think about a company. We don't just look at return on assets, though. We also look at asset growth. And for asset growth, you can see it's the same thing. The orange bars are the distorted as reported asset growth. The blue bars are the real asset growth for this company. The way you can think about this in terms of these two charts are these two charts are a more thoughtful, intelligent way for you to think about free cash flow, right? If you think about it, if you have $100 of assets invested in your business, this company is throwing off $47 a year in operating profits and operating cash flow, and they're reinvesting $16. So this company is throwing off an extra $31 a year for every dollars of assets it has in the business, basically, in free cash flow that it could use to either acquire, to return capital to shareholders, et cetera. And it's just a really powerful way to understand it, because it also helps you understand for companies, when you're looking at companies with negative free cash flow, how it is that they're getting there. Because there are negative free cash flow companies, some of them are good and some of them are bad. If you have a negative free cash flow company because our uniform accounting ROA is negative, well, that tells you it's a bad business. But you have a negative free cash flow company because you have ROAs that are 40% and it's just growing at 50 to 60% a year because it's compounding that business. That's not a bad thing. That's a negative free cash flow company that you want to invest in. It's a really compelling business. So these are about understanding the performance of the company. But then we want to understand, right, understanding if a company is undervalued or overvalued isn't about what its old performance is. It's about what the market is paying for that performance and how that means the market expects performance to be in the future. So this next chart here is the value to asset prime ratio, right? We're looking at an as reported price to book and our uniform accounting adjusted price to book assets. Why? Because there's a very strong relationship between the multiple you trade at relative to your price to book when we make all the uniform accounting adjustments and how profitable the business is, right? Higher return businesses earn a higher multiple. And also looking at this helps us understand when companies are trading very inexpensively, at say sub 1 times, when it is that we actually might be looking at a company that the market has had offer floor valuations on. Then we look at our uniform accounting PE, which we call a value to earnings prime ratio, relative to the as reported PE in a classic way. And the last chart we have here is TSR-R. TSR, for those of you who don't know, means total shareholder return. It's the total dividend income and capital appreciation that you get from a stock on a yearly basis. And the second R here is relative. Relative to what? Relative to the market, which for this company, because it's a US listed name, is the S&P 500. When we see this flat, when it's flat from year to year, that means that the company's stock performed in line with the market. When it rises, that means it outperformed the market. When it falls, that means it underperformed the market. And so we can just understand over time. And what you see is over time, there's a very strong relationship between our uniform accounting numbers and the total shareholder return relative to the market. But right, all that is about what the company's done and what the market is paying as a valuation. The real question for good stock pickers is the company undervalued or overvalued? And with that in mind, that's why we had these final 5 bars here. These 2 light blue bars here are what Wall Street sell-side analysts are forecasting returns to be for Perficient for the next 2 years. When we take in Wall Street estimates for net income, for revenue, for CapEx, and we then make the uniform accounting adjustments to them, what we can see is analysts are forecasting returns to rise from 47% to 48% to 51% over the next 2 years. Then what these white bars are, these white bars for both asset growth and for ROA are what the market is pricing Perficient to do at a $44 stock price or at a $1.5 billion valuation. If Perficient can see ROAs higher than 43% and growth higher than 4% a year for the next 5 years, the company's undervalued. If it can't, if returns are going to fade back to what basically corporate averages have been for the last 15 years, or 12 at least, then the company's fairly valued right now. If it falls below, it's overvalued. And this is a really powerful thing for our clients that the tool lets them do. It doesn't just let them understand what is the real performance of the name and what's its real real returns, what we see through the accounting noise. It also helps you have a very quick conversation about the first question that investors should always ask. Right? If you talk to Bill Miller, if you talk to Seth Klarman, if you talk to any of the investment grades, what they all say is the first thing you need to do is to understand what the market is thinking. And only after you understand what the market is thinking can you then go on and decide whether or not you think a stock is undervalued or overvalued, because then you can talk about whether or not your opinion differs from the market, what we call embedded expectations. And so, right, your question and the ability that you have using this tool is you can speed up your investment research conversations, because instead of having to build an entire model and then having the team get familiar with the model, et cetera, you can look at a company, you can pull this up and you can have a conversation. Do we think something has structurally changed about Perficient's business relative to what it's done for the last 12 years that makes us think it can earn a higher return than its average return over the last 12 years? That's a really straightforward question to ask. And if you say no, then you move on. If you say yes, then you can spend some time. And right, what we can do here is we can do really simple scenario analysis. And let's say that we think Perficient in the middle of this downturn is going to use this downturn as an opportunity to keep on buying up smaller design agency businesses to basically be a consolidator in the space and drive growth. Right? If we think that that's going to be the case, then all of a sudden what we're looking at here is a company that if it is, then returns only need to be above 32% a year going forward for us to be able to justify current valuations. So now let's do the final part of the question is, let's say we think that it can grow at 12%, but we also think it's going to continue to be the, call it 42% on average business, let's say 45% on average ROAs that it has been historically. What's the company worth? We can do that kind of scenario analysis quickly here to say, well, will it even be undervalued enough that it's worth us spending time on, right? Because if the name is only going to be undervalued by, let's say, I don't know, 20% or less, it's not that compelling. But here, we're looking at if the company just does this, which is what it's done the last 2 years, company's 45% undervalued, right? If I think that it can continue to improve its ROAs, and right, ROA can rise up to 54%, this company might be worth, what, 70, 80% undervalued? And that's what's so powerful is what we can do is we can use this kind of framework to, one, see through the accounting noise and understand what is the real profitability of a business, and then two, understand once we can see that what the market's pricing in and whether or not the company's undervalued or overvalued.
Valens Research, the world's leading source for uniform financial analytics.